All right, let's dive deep today.
Sounds good.
We're going to tackle managerial accounting. We've got this textbook, Principles of Managerial Accounting.
Classic.
There's more to uncover than you might think.
Yeah.
Ever feel like those financial reports are just a bunch of numbers just swirling around?
Oh, yeah.
Well, today we're going to try to decode them. Think of it as your crash course.
Okay.
To use financial data to make smarter decisions in your business.
For your business, yeah. It's fascinating. Managerial accounting is like a secret weapon, especially when you compare it to financial accounting.
Okay, it's hardly different.
Financial accounting is all about reporting, got to play by the rules, GAAP, all that. But managerial accounting, this is like your behind-the-scenes playbook.
So if financial accounting is like the polished presentation we give to the outside world, managerial accounting is the raw data that helps us steer the ship from within.
Exactly. It's giving you the insights to make decisions that boost your bottom line.
Not just reporting to investors or the tax man.
Right. And because it doesn't have to follow GAAP, you can tailor the information to fit your company's specific needs.
Makes a lot of sense. Now, the textbook dives into different types of businesses, service, merchandising, and manufacturing. I'm guessing this is more than just like a classification exercise.
You're right. It's about understanding how these principles, the core principles of managerial accounting, apply differently depending on what your business does.
Okay, so give me an example.
A service business sells expertise, a merchandising business buys and resells products, and a manufacturing business makes those products from scratch.
Okay, so even if I'm not running a factory, these accounting principles can still help me understand the costs of running my business.
Absolutely. Whether you're a consultant, a retailer, or a tech startup, you need to know how much it costs you to deliver your product or service.
That's the foundation of profitability. Okay, so now we're getting to the good stuff. Cost accumulation. The textbook throws around terms like job order costing, process costing, and activity-based costing. It feels a bit overwhelming, honestly.
Don't worry, it's not as complicated as it sounds.
Okay.
Think of it as different lenses for understanding your costs. Imagine like a detective trying to solve a case. They need different tools to uncover clues and piece together the story.
Okay, I like that analogy. So each costing method is like a detective tool helping us uncover the real story behind those costs.
Precisely. Job order costing is great for tracking costs on specific projects,
Like
custom furniture or website design. Process costing is perfect for businesses with a continuous flow of identical products,
Okay.
like our cookie factory example.
Okay.
And activity-based costing digs deeper to pinpoint what's driving your overhead costs.
So the key is to choose the right tool for the job.
Exactly. Understanding the nuances of each costing method and applying the one that helps you see your costs with the most clarity.
Okay, now the textbook also talks about period costs and product costs. I'm guessing this is a pretty important distinction.
It's crucial. Think of it this way. Period costs are like the rent you pay for your office space. They happen regardless of how much you're producing or selling.
Okay.
Product costs are directly tied to creating your product or service.
So let's say I'm running a bakery. The cost of the flour, sugar, and the baker's wages are product costs. But my marketing budget and the rent for the bakery space, those are period costs.
You got it. And understanding this difference is key for calculating your profit margins accurately. You wouldn't want to think you're making more money than you actually are.
That would be a nasty surprise. All right, let's tackle the income statement. Sales minus cost of goods sold equals gross profit. Then we subtract operating expenses to get net income. Seems pretty straightforward.
It is, but here's where it gets interesting.
Okay.
Cost of goods sold isn't just a simple number. It's calculated based on the flow of your inventory.
What do you mean?
Think of it like a river. Raw materials flow into work in progress, then finished goods, and finally, the cost of those goods sold flows out. Each stage tells a story
About
your business's efficiency.
Hold on, let me make sure I'm following.
Sure.
So if I mess up my inventory management, my cost of goods sold could be way off, and that messes up my entire income statement.
Exactly. It's like a chain reaction. If you have too much inventory sitting around, your costs go up.
Yeah.
Too little, and you might miss out on sales. Understanding this flow, you can optimize your entire operation.
Okay, I'm starting to see why accurately tracking costs is so important.
Yeah.
Now, the textbook mentions job order costing. They use the example of creative content.
Yeah, the creative agency.
Yeah, what's the takeaway there?
Think of it this way. Imagine you're working on multiple projects at once, each with different clients and budgets. Job order costing allows you to track the costs of each project individually so you can see exactly how much profit or loss each one is generating.
So it's like giving each project its own mini income statement.
You got it. This way you can make sure you're not accidentally subsidizing unprofitable projects with your more successful ones.
That's a smart way to manage resources. Now, the textbook uses a cookie factory to illustrate process costing. Tell me more about this one.
Remember how we talked about inventory flow?
Yes.
Process costing is all about tracking costs as products move through different stages of production. Imagine your cookie dough going through mixing, baking, and packaging departments. By tracking costs at each stage, you can pinpoint bottlenecks, reduce waste, and ultimately make your cookies more profitable.
It's like having a financial map of your production process.
Exactly. And this map can help you identify areas for improvement, even in a seemingly simple process like baking cookies.
Okay, now the textbook introduces activity-based costing, or ABC. It makes it sound like a more precise way to allocate overhead costs.
Think of it this way. Instead of just lumping all your overhead costs together and spreading them out evenly, ABC digs deeper. To understand what activities are really driving those costs, it's like figuring out how much of your electricity bill is due to running the ovens versus lighting the office.
So ABC helps us see the cost of each slice of the pie rather than just the whole pie itself.
Precisely. And this granular view can help you make smarter decisions about pricing, resource allocation, and even process improvement.
Okay, we've covered a lot of ground here. Different costing methods, inventory flow, and how they all tie back to understanding our true profitability. But before we move on to more exciting concepts, let's talk about cost behavior.
Yes. Understanding how your costs behave is crucial for making informed decisions, especially when it comes to pricing and production levels.
Okay, and how do we do that?
The textbook defines fixed costs, variable costs, and mixed costs.
Right, so fixed costs like rent stay the same no matter how much you produce. Variable costs like raw materials increase as your production goes up. And mixed costs have elements of both.
Think of it this way. If you're running a pizzeria, your rent is fixed, your ingredient costs are variable, and your utilities might be a mix of both. A fixed base rate plus a variable cost, depending on how much pizza you're baking.
Okay, that's a delicious way to illustrate it. So knowing how our costs behave is crucial for
cost volume profit analysis, or CVP analysis.
And what is that?
It's all about understanding how changes in costs and sales volume impact your profit.
I'm intrigued. Tell me more about the CVP analysis.
It helps you answer questions like how many pizzas do I need to sell to break even, or what happens to my profit if I raise my prices. It's all about understanding the levers you can pull to reach your financial goals.
This is starting to sound really powerful. Now, the textbook mentions budgeting as well. It seems pretty straightforward, right? Projecting our future income and expenses.
It is, but the real magic of budgeting lies in using it as a tool for making proactive decisions, not just reacting to what's already happened. A budget is like a roadmap.
So it's not just about predicting the future, it's about using those predictions to steer our business in the right direction.
Exactly. A budget helps you set financial targets, allocate resources effectively, and monitor your progress towards your goals. It's about taking control of your financial destiny.
Okay, now I'm really seeing the value of budgeting. The textbook also dives into variance analysis. This sounds a bit like comparing apples and oranges. What is it exactly?
Think of it this way. Imagine you plan to spend $100 on ingredients, but you end up spending $120.
Okay.
Variance analysis helps you figure out why there's a $20 difference. It's like being a financial detective, uncovering the reasons behind those unexpected cost fluctuations.
So it's not just about noticing the difference, but understanding the root cause.
Exactly. Is it because the price of flour went up? Did you accidentally spill a bag of sugar? Or maybe you had to bake extra pizzas because of a surprise rush?
Okay, so variance analysis helps us understand the why behind those unexpected numbers, which can then lead to better decisions in the future. This is starting to feel less like just accounting and more like business strategy.
That's exactly what it is.
Yeah.
Managerial accounting isn't just about keeping score. It's about using those scores to improve your game plan. It's about turning financial data into actionable insights that help you achieve your business goals.
Yeah.
It's amazing how even something as seemingly simple as sales forecasting can have such a ripple effect throughout a business.
Yeah, it's true. I mean, if we don't have a good grasp of how much we're likely to sell, how can we possibly plan for everything else?
Exactly.
That goes into running a business.
Imagine trying to bake a cake without knowing how many people you're serving.
Oh, yeah.
You might end up with a tiny cupcake
Right.
when you need a 3-tiered masterpiece, or vice versa.
Yeah, that's a delicious analogy.
So sales forecasting is like that first crucial step in the recipe for business success. Sets the stage for everything else. Production planning, inventory management, staffing, marketing, even financing.
Yeah.
A well-crafted sales forecast is like a roadmap guiding you towards your financial destination.
The textbook mentions a bunch of different forecasting methods.
Oh, yeah.
From simple trend analysis to those fancy statistical models.
Right.
It all seems a bit daunting.
Don't worry, it's not about becoming a statistic whiz overnight.
Okay, good.
The key is to choose the method that's right for your business.
So how do I know which one is right for me?
A small business owner might be able to get away with simple trend analysis, looking at past sales patterns to project future demand.
So if my sales have been steadily increasing by 10% each year for the past few years, I could reasonably assume a similar growth rate for next year.
Exactly.
Okay.
But for larger companies or those in more volatile markets, those sophisticated models might be necessary.
To capture all the nuances and variables that influence sales.
Exactly.
So it's about finding the right balance between simplicity and accuracy.
Precisely. And remember, no forecast is perfect.
Sure.
It's about using the best available information to make informed decisions.
Knowing that you might need to adjust course along the way.
Right.
Speaking of adjustments, the textbook talks about differential analysis, a tool for comparing different options.
Yeah.
Sounds like a decision-making superpower.
It is.
Okay, tell me more.
Imagine you're at a crossroads,
Okay.
trying to decide which path to take.
Right.
Differential analysis helps you weigh the costs and benefits of each option, focusing on the differences that matter most.
So it's not about picking the cheapest option.
No.
It's about understanding the trade-offs and making the choice that aligns with your overall goals.
Exactly.
Can you give me an example?
Let's say you're a manufacturer,
Okay.
considering whether to make a component in-house or outsource it to a supplier.
Right.
Differential analysis will help you compare the costs of each option, factoring in not just the raw materials, but also labor, overhead, transportation, even the opportunity cost of using your resources for something else.
So it's a holistic view, considering all the relevant factors.
Exactly.
Can you give us another real-world example?
Sure. Imagine you're a retailer deciding whether to open a new store location.
Okay.
Differential analysis will help you compare the potential revenues and costs of that new store.
Factoring in things like rent, staffing.
Exactly. Inventory, even the potential impact on sales at your existing stores.
So it's like a financial simulation, helping us see the potential consequences of our decisions before we actually make them.
Exactly. And it allows us to quantify those consequences.
Okay.
To put hard numbers behind our gut feelings.
And make more data-driven choices.
Right.
This is amazing.
It is.
Okay, now the textbook also dives into capital budgeting, those big investment decisions
Yeah.
that can make or break a business.
Capital budgeting is all about those long-term investments that shape the future of your company. Buying a new piece of equipment, expanding your facilities, even acquiring another business.
Right.
These decisions can be exciting, but also nerve-wracking.
Because they involve significant upfront costs and have long-term implications for your financial performance. So we need to be extra careful and strategic with these decisions.
Absolutely. And that's where capital budgeting techniques come in.
So tell me about those.
They provide a framework for evaluating those potential investments.
Okay.
Comparing different options and choosing the projects that are most likely to generate a positive return on investment.
The textbook mentions a few different methods for evaluating capital projects. Payback period, net present value, and internal rate of return.
Yeah, those are the big ones.
Can you break those down for us?
Sure.
Okay.
Imagine you're considering buying a new delivery truck for your business.
Okay.
The payback period tells you how long it will take for the cash flows generated by that truck
Like the money you save on delivery costs.
to pay back the initial investment.
Yeah. So if the truck costs $50,000 and it saves you $10,000 per year, the payback period would be 5 years.
Exactly.
Okay.
It's a simple way to get a sense of how quickly you'll recoup your investment.
Okay. But are there any downsides to that method?
It doesn't consider the time value of money,
What does that mean?
meaning it doesn't account for the fact that a dollar today is worth more than a dollar in the future.
Due to things like inflation.
Right, and the potential to earn interest.
Right, because that $10,000 in savings 5 years from now won't have the same purchasing power as $10,000 today.
Precisely. And that's where net present value, or NPV, comes in.
Okay.
NPV takes those future cash flows
Yeah.
and discounts them back to their present value.
Using
A discount rate that reflects your cost of capital.
Okay.
Essentially, it tells you how much that investment is worth today.
taking into account the time value of money.
Right.
Okay, so NPV gives us a more accurate picture of the true value of an investment.
Over its lifespan.
Yeah.
And if the NPV is positive, it means the project is expected to generate a return that exceeds your cost of capital, creating value for your business.
Okay, and what about the internal rate of return, or IRR?
The IRR is the discount rate that makes the net present value of an investment equal to zero.
Okay.
Think of it as the rate of return
Okay.
you can expect to earn on that investment.
So if the IRR is higher than our required rate of return, the project is considered attractive.
You got it.
Okay.
It means the project is expected to generate a return that exceeds your cost of capital, creating value for your investors.
This is all starting to make sense.
Yeah.
But in the real world, do businesses actually use all three of these methods
They might.
when evaluating capital projects
Often it's a combination.
of these methods?
Yeah, the payback period is a quick and easy screening tool, while NPV and IRR provide more sophisticated insights into the long-term value creation potential of an investment.
So it's about choosing the right tools for the job, depending on the complexity of the project and the level of detail required.
Exactly. And remember, capital budgeting isn't just about number crunching.
Right.
It's about using financial analysis to inform those big strategic decisions that will shape the future of your business.
Thinking like an investor, weighing the risks and rewards, and making choices that align with your overall vision and goals.
Exactly.
Now, the textbook emphasizes how important budgeting is for a business, but it can feel a bit like guesswork, right?
Yeah.
I mean, how can we possibly predict the future with any certainty?
Right.
There's always an element of uncertainty when it comes to forecasting the future.
But that doesn't mean budgeting is pointless.
Okay.
It's more about creating a roadmap, a plan of action.
Based on the best available information,
Right.
and then being flexible enough to adjust course along the way.
Exactly.
So it's like setting sail with the destination in mind, but being prepared for unexpected winds and currents.
Exactly. And a well-crafted budget is more than just a set of numbers.
It's a communication tool
It's a way to align your team
around shared financial goals.
and track your progress towards those goals.
So it's not just about predicting the future. It's about using those predictions to make proactive decisions and guide the business in the right direction.
Precisely. A budget helps you allocate resources wisely, make strategic trade-offs.
And hold yourself accountable for your financial performance.
Exactly. It's about taking control of your financial destiny.
This is starting to feel less like accounting and more like empowerment.
Exactly. Managerial accounting isn't just about crunching numbers. It's about using those numbers to make smarter decisions, achieve your goals.
And ultimately build a more successful and sustainable business.
Right.
Okay, the textbook also dives into something called variance analysis. It makes it sound a bit like comparing apples to oranges.
Yeah.
What is it exactly?
Think of it this way. Imagine you plan to spend $100 on ingredients for your bakery.
Okay.
But you end up spending $120. Variance analysis helps you figure out why there's a $20 difference. It's like being a financial detective, uncovering the reasons behind those unexpected cost fluctuations.
So it's not just about noticing the difference,
No.
but understanding the root cause.
Exactly. Was it because the price of flour went up? Did you accidentally spill a bag of sugar? Or maybe you had to bake extra cakes because of a surprise birthday party rush?
Okay, so variance analysis helps us understand the why behind those unexpected numbers, which can then lead to better decisions in the future. This is starting to feel less like just accounting and more like business strategy.
That's exactly what it is. Managerial accounting isn't just about keeping score. It's about using those scores to improve your game plan. It's about turning financial data into actionable insights that help you achieve your business goals.
So if budgeting is about setting our financial goals and creating a roadmap, variance analysis is like checking our GPS along the way, making sure we're still on track and adjusting our route if needed.
That's a great analogy. And just like a GPS helps you avoid traffic jams and road closures, variance analysis helps you identify potential problems early on so you can make course corrections before those minor deviations turn into major detours.
Okay, I'm starting to see how these concepts all fit together, but how do we actually use variance analysis in a practical way?
Well, imagine you're running a manufacturing company and you notice that your actual labor costs for the month are significantly higher than what you budgeted.
Okay.
Variance analysis helps you break down that overall variance into smaller pieces to understand what's driving the difference.
So we're not just looking at the total labor cost, we're examining the individual components that contribute to that cost.
Exactly. We might look at the price variance. Did we have to pay our workers a higher hourly rate than we anticipated? And we also look at the quantity variance. Did our employees work more hours than we planned?
I see. So by analyzing those two components,
Yeah.
price and quantity, we can start to pinpoint the root cause of the variance.
Precisely. And that's the key to taking corrective action.
So give me an example.
If it's a price variance, maybe we need to reevaluate our wage rates.
Okay.
Or explore ways to improve employee retention to reduce the need for costly overtime.
And if it's a quantity variance,
We might need to examine our production processes to identify inefficiencies or bottlenecks that are causing our employees to work longer hours.
this is fascinating. It's like having a magnifying glass for our business operations,
Yeah.
allowing us to zoom in on those areas where we're deviating from our plan and figure out why.
Exactly. Variance analysis isn't about pointing fingers or assigning blame. It's about using data to understand what's happening in our business and make informed decisions to improve our performance.
Okay, so we've got budgeting for setting our financial goals, variance analysis for tracking our progress, and identifying areas for improvement. Now the textbook mentions something called contribution margin analysis. Sounds intriguing.
Yes. Contribution margin analysis is a powerful tool for understanding how much each unit we sell contributes to covering our fixed costs and generating profit. It's a way to dissect our profitability, product by product, service by service.
The textbook defines contribution margin as the amount that remains from sales revenue after subtracting variable costs.
Exactly. It's essentially the portion of each sale that's available to contribute to covering those fixed costs and ultimately contributing to our profit.
Okay, so it's like figuring out how much each sale is really worth to us once we've accounted for those direct costs associated with producing or delivering that product or service.
Precisely. And the beauty of contribution margin analysis is that it can be used to compare the profitability of different products, regions, salespeople, or even distribution channels. It's incredibly versatile.
Can you give us an example of how this might work in practice?
Sure. Let's say you're a clothing retailer and you sell both basic t-shirts and premium designer jeans. Contribution margin analysis can help you determine which product generates more profit per unit sold, taking into account both the selling price and the variable costs associated with each item.
That's valuable information for making decisions about our product mix, pricing strategies, and marketing efforts. We might decide to focus our efforts on promoting those high margin designer jeans, for example.
Exactly. Or perhaps you're a restaurant owner and you want to figure out which dishes on your menu are the most profitable. Contribution margin analysis can help you pinpoint those star performers, allowing you to optimize your menu offerings and pricing to maximize your overall profitability.
It's like having a profitability microscope, allowing us to zoom in on different aspects of our business and understand what's driving our financial results.
It's about using data to guide our decision making and ensure we're focusing our efforts on the areas that generate the greatest return.
This is all starting to make sense. But before we completely wrap up this episode, I have one more question that's been on my mind.
Fire away.
We've talked about how managerial accounting helps us understand our costs, analyze our profitability, and make informed decisions. But how does this all tie back to the overall strategy of the business?
That's a crucial point. Managerial accounting isn't just about crunching numbers in a vacuum. It's about aligning our financial decisions with our overall strategic goals. It's about using financial data to tell a story, the story of how our business is performing and how we can achieve our long-term vision.
So it's about connecting the dots between our financial performance and the big picture vision for the business.
Exactly. Let's say your company's strategic goal is to become the market leader in sustainable manufacturing practices. Managerial accounting can help you translate that goal into specific financial targets and action plans. Like, well, you might set a target to reduce your waste by 20% over the next year. Managerial accounting can help you track your progress toward that goal, identify areas where you're excelling or falling short, and make adjustments to your operations to ensure you achieve your target.
So it's about using financial data to measure and monitor our progress towards those strategic goals.
Precisely. You might also decide to invest in new energy-efficient equipment that will reduce your environmental impact. Capital budgeting techniques can help you evaluate the financial viability of that investment, ensuring it aligns with your long-term sustainability goals.
It's amazing how managerial accounting can weave itself into every aspect of the business, from operational efficiency to strategic decision making.
It's the financial thread that connects all the pieces, ensuring we're moving in the right direction and creating value in a way that's sustainable and aligned with our core values.
I'm starting to see how managerial accounting is more than just a back office function. It's a strategic partner, a vital contributor to the success of any business.
It's about empowering everyone in the organization, from the CEO to the frontline employees, to make informed decisions that drive profitability, growth, and lasting impact.
This has been an incredible journey. We've explored a vast landscape of topics, from costing methods and variance analysis to budgeting, differential analysis, and even capital budgeting.
It's been a pleasure sharing these concepts with you, and I hope it's inspired you to see the power and potential of managerial accounting.
I'm already eager to apply what I've learned to my own endeavors, but before we completely wrap up, I have one more question that's been bubbling up in my mind.
I'm all ears.
The textbook dives into a lot of detail about how to calculate costs, analyze variances, and project financial performance. But in the real world, with all its uncertainties and complexities, how do we ensure that these numbers are actually reliable and meaningful for guiding our decisions?
That's the million-dollar question, isn't it? Yeah. It's tempting to think that managerial accounting is all about plugging numbers into formulas and getting like a definitive answer.
Right, like it's some kind of magical crystal ball that reveals the future of our business.
Yeah, but the reality is that those numbers are only as good as the information that goes into them.
So it's not just about the math.
And that's where human judgment comes in.
So we can't just blindly trust the numbers. We need to apply critical thinking and consider the bigger picture.
Exactly. It's like baking a cake. You can follow the recipe precisely.
Yeah.
But if your oven temperature is off or your ingredients are stale,
The cake won't turn out as expected.
right.
Okay, I'm starting to see the analogy. Here's where my brain gets a little fuzzy though. We've talked about different costing methods,
Yeah.
but the textbook mentions two specific approaches that seem important: variable costing and absorption costing.
Okay.
What's the difference and why should we care?
That's a great question. And it gets to the heart of how we account for our fixed manufacturing overhead costs.
Those
Those costs that don't change directly with the number of units we produce, like rent, property taxes, supervisor salaries, things like that.
Okay, so those fixed costs are always there regardless of whether we're churning out products like crazy or just keeping the lights on.
Exactly. And absorption costing, which is the standard for external reporting.
Those financial statements we share with the outside world?
Right, includes those fixed overhead costs in our inventory valuation. Each unit we produce absorbs a portion of those fixed costs.
Okay, that makes sense. Those fixed costs are part of the overall cost of producing those goods, even if they don't fluctuate with production volume.
Right, but here's where variable costing comes in.
Okay.
This method only includes the variable manufacturing costs, like direct materials and direct labor, in the cost of goods sold.
So with variable costing, those fixed manufacturing overhead costs are treated differently.
Exactly. They're treated as period expenses,
Meaning?
they're expense in the period they're incurred, regardless of how much we produce or sell.
Okay, my brain is trying to keep up. So under absorption costing, some of those fixed overhead costs are kind of stuck in inventory.
Yeah, until those units are sold. Right. Well, under variable costing, they're expensed right away.
You got it, and that can have a significant impact on our reported profitability, especially if our production volume fluctuates.
Okay, now I'm really curious. Can you give us a hypothetical scenario to illustrate how this might play out in the real world?
Sure, imagine you're a furniture manufacturer.
Okay.
Let's say you produce 1,000 shares in a month, but only sell 800.
All right.
Under absorption costing, some of those fixed overhead costs would be allocated to the 200 unsold shares sitting in inventory,
Which does what to our profit?
boosting your reported profit for the month.
Okay, so it looks like we're making more money than we actually are, because those fixed costs haven't been fully expensed yet.
Exactly. But under variable costing, those fixed overhead costs would be expensed in full during the month, regardless of how many shares we sold, resulting in a lower reported profit. It's a more conservative approach.
So which method is better? It seems like variable costing gives us a more accurate picture of our true profitability. It depends on what you're trying to achieve.
I see.
Absorption costing is the standard for external reporting,
Yeah.
but internally, many companies use variable costing for decision making because it provides a clear view of how costs behave in relation to production volume.
So it's like having two different lenses for viewing our profitability, one for the outside world and one for our internal decision making.
Precisely. And it's important to understand both methods and how they can influence our financial reporting and analysis.
This is really making me think differently about those numbers on financial statements. It's not just about crunching the numbers, but about understanding the nuances behind them.
Exactly. Managerial accounting is about using those numbers to tell a story, to make informed decisions, and to guide our business towards greater success.
This deep dive has been incredible. We've explored such a vast and fascinating world, but it feels like we've only just scratched the surface.
There's always more to learn, but I think we've laid a solid foundation for understanding the power and potential of managerial accounting.
I completely agree. It's been an eye-opening experience, and I'm already thinking about how I can apply these concepts to my own business ventures.
That's the best part. Managerial accounting isn't just theory, it's a set of practical tools that can help you make smarter decisions, optimize your operations, and achieve your financial goals.
Well said. Thanks for joining us on this deep dive into the world of managerial accounting. We hope you found it enlightening and inspiring. We'll be back soon with another deep dive into a new and fascinating topic. Until then, keep those brains buzzing and those entrepreneurial spirits soaring.
Until next time.